This is part 2 of the master budget. We just finished talking about the production budget, and once we know how many units that we're going to produce, then we need to set aside resources in order to make that happen. And the first of which is going to be, well, we need to buy some materials. So notice that the schedule of materials purchases budget is going to have the required production in units that we just calculated. Now, I did not copy and paste. Remember, again, create the links between the budgets so that they're connected. Now, since I'm dealing with materials, I want to come over to the materials section of the data handout so that we know exactly what we need to track. Our estimates say that each unit should take 5 pounds of material. Now, just like earlier when I said that we were working under very simple assumption that we're only selling one product, one unit, I'm also working under the assumption that this product only requires one type of material. Now, of course, I know that's not really realistic, because even with a simple, say, manufacturing a shirt, we're going to have more in it than just cloth. We'll have thread and buttons and other kinds of decoration. Those would all be materials. But again, if you can track it for one material, you can do it for as many as is necessary. So each material, each unit requires 5 pounds of material, and these are expected to cost $2.25 a pound. So let's go back over here and see what I'm going to do with that information. Well, I inputted the 5 pounds for each unit, and then I just simply multiplied the units by the pounds per unit to get the total pounds necessary to meet production. Now, I'm going to use a similar approach that I did back here on the production budget. We don't want to buy just enough materials to get us through the production. What are we going to have to use when we start working on the next increment for the next month? Well, we need to make sure we still have some materials on hand. This does not mean that we're going to have vast stockpiles, but I need to have some on hand with which I can work. And we may not be able just to go down to a neighboring business and pick up these materials. Some of these may have to travel long distances, or maybe they are only available at certain times of the year. So your expectation of what you need to have on hand is going to vary depending upon the nature of your product and company. So in this case, we want to have on hand 40% of next month's production needs. So I said, all right, let's take 40%, and of next month's production needs, which would be February, I need 18,580 pounds. Now, if that seemed familiar to you, taking a percentage of the following month, that's exactly what we did up here on the production budget. So the same procedure is being utilized. I'll do the same thing for February, which would be 40% over here of March. But when I get to March over here, I need 40% of April. And we haven't done all that work yet. So we really need to come back up here to complete April. So when I look at April over here, we need to know, well, how much do you want to have on hand, which would be the desired. And we had said over here that we wanted 30% of the next month. Well, the next month after April would be May. And so if I go back to that data sheet, you can see that we do have May's data, which would be 11,000 units. So I'm going to take that 11,000, put that in place, and I'm going to find the 30% of that next month, 3,300. So I can add those two. Of course, I get this diagonal effect the end of March automatically becomes the beginning of April. And then I can just find the difference here. And that says that that's how many units I need to do in April. And of course, when I come down here and then take 5 pounds at each one of those, we have how much we need for April. And then March is simply going to be 40% of that. Now this is the most tedious thing that we're going to have to do on these initial budgets. We don't usually have to go this far into the next months in order to get a value. And again, just as before, don't forget the end of March and the quarter, they have to be the same. So I know how much I need to have just to meet production. Now I know how much I need to have on hand to keep producing. And so when you add those two, you get your materials needed. And I can do that for all the months in the quarter. Now don't forget, that diagonal effect is going to show up again. The end of one month becomes the beginning of the next, and so on. So that means January would have received its beginning materials from December. And according to our data sheet, it said that a total of 21,000 pounds were on hand at the beginning of the quarter. So I put the 21,000 there. And then the last thing I want to point out again is the beginning, which is January, is also the beginning for the quarter. Now, I know I went through that a little bit faster, but all of this is the same approach that we just did up here. So let's find the difference. If you need 69, you already have 21, then you only need to buy 48, and do that for each of the months in the quarter. And then recall, we said that each pound was going to take $2.25, and then just a simple multiplication will get you the total cost. And that will get me the schedule of materials purchases budget. Now, the budget that I'm going to prepare after this one is how are you going to pay for it? So this is going to be our disbursements for purchases budget. So they are two different ones here. If I come back over here to the data sheet, it tells me how I pay for this. It says that all purchases are made on credit, and this makes perfectly good sense. I can't just go down to a business and fill up my shopping cart and go up to the cash register and pay for all my materials per se. I may be ordering these and then they get delivered to me, and of course I get a bill, so that means it would be on credit. Now, of course, when someone says, I'll pay you later, there's a risk that someone's not going to pay you and you don't want to be out of that money. So you will oftentimes put some kind of incentive on there to encourage people to pay early. And this is what is called a discount. And these right here are discount terms. And this basically says that if you pay your bill within 15 days, you will receive 2% off the price. Otherwise, in 30 days, the net balance is due. Now that net balance means maybe you had returned some because it wasn't suitable for whatever reason. So your net would be the balance on your account. So these are discount terms to encourage you. And then this is how it says that inventory purchases are expected. Now, notice it says that inventory purchases are made on credit, and those are the terms, but there are some things that we are actually going to buy with cash. So, not a very big chunk of them, but some of it could be in cash. Maybe there is another business in town that's local, and we can go and purchase it in person and pay cash. Maybe some businesses do not allow credit purchases. Or maybe this is even a business that's not even local, and in order for us to get sent that merchandise, we have to do an electronic funds transfer. In other words, you got to pay for the cash purchase today. So however this is transpiring, some of our acquisitions are with pure cash, and then others are on credit. And these 80% that are on credit, well, they're subject to these discount terms over here. The last piece of information I need to know is the fact that half of what I buy on credit is paid this month, and we pay the other half next month. Alright, so I want to do something similar to what I did with the credit sales. Let's do the credit purchases. And remember that these were represented 80%. So I'm going to use a similar setup like we did up here. January, February, and I guess I'll go ahead and put April on there with March. And then of course I can do these over here. So here's what we know to be true. If you buy anything on credit, we said 50% or half is paid this month with the balance due next month. So 50% is here, and the other 50% is in February. And for February's current, I'll do 50% in February, 50% in March, and so on down the line. And that means another half will carry over into April. So just like we saw before, we have two pieces in each month, and that means I'm missing something over here in January. And of course, this would have been values that were stemming from activity in December. Now remember, December is known data, and these credit purchases, well, they've been paid. But these over here, the other half, is to be paid in January. Now, since, again, December is known data, I don't have to do this estimation of, well, 50%. You know how much you owe because what you didn't pay is still there. And we call this accounts payable. And if I go back to my data sheet, we can see that there is an accounts payable of $30,000. Now, that is what I need. So, really, this is $30,000. I can put that in there. And just like we saw up there with the sales, this over here will be my ending accounts payable. And we'll come back and calculate that in just a bit. So, let's take all of this and put it into my budget. Alright, so you can see I actually broke this thing up a little bit different just to show a variation. We're going to track what was from last month and then what is for the current month. So remember, from last month, which is December, we still owe $30,000, and that's where that came from. For the current month, it said, recall that 20% of what I'm buying is cash. So of what I'm buying, well, 20% of that is what I'm paying. And I would do the same thing over here for February and March, just take 20% of what I'm buying. Now, what is credit over here, remember that is 80%. And so 80% is $87,984. Now, that is just the raw credit. Recall, one last trip back over here, that we are paying half of it in January. So I need to do one more modification with this. I need to put the 50% behind it. And when I do that, then it yields me the amount that I am paying for credit purchases in January. Now the other 50% of that is going to come over here in February. So let's take the credit purchases from January and multiply that by 50%, just like we did over here. And then, of course, you can see that yields. Now, please, 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 do not assume that these will always be equal. That is just because of circumstances in this case, and I'll explain in just a moment. But these are not the same. This is 150%, and this is a different 50%. They are not the same 50%. I would take this approach in calculating February and March, and again, don't forget that even though you can take the 80% to get the credit for the current month, we got to know how much we're paying. Next thing, we can just tally all of what you're paying. But we need to talk about those discounts. So I want to come back and do a little bit more with what's over here. Now, recall it said that anything that is on credit is subject to 215 net 30 discount, 2%. So let's consider a typical month. A typical month has, on average, 30 days. So I'm going to just draw myself basically a little timeline over here. And this timeline is going to represent a typical month. So this right here can be January, and this, of course, over here would be February. But remember, on average, we have 30 days in a month, on average. So this will balance out. So if a typical month is 30 days, then this first block would be 15 days, this second would be 15 days, and so on. Now recall, if you buy something on credit and pay within 15 days, you get a discount of 2%. So if I buy somewhere in this first 15 days, I better be paying for it over here, which would be within 15 days, so I could get a 2% discount. And if I bought something over here the last 15 days, I better pay it over here the first 15 days of February in order to get that discount. And again, so on throughout the time. So basically, here's what I noted. What I buy in January, half of it is indeed paid in January. The other half is paid in February. Hence, 50% this month, 50% next month. Now this would all change if the discount terms vary. So let's say that it's not 215, but let's say it is 210 net 30. Now in this case, you only have 10 days to pay that bill. Now remember, if this is a typical, on average, 30 days in a month, then in the first 10 days, you have to pay this between the 11th and the 20th to get the discount. And if you bought something between the 11th and the 20th, you got to pay for that between the 21st and the 30th to get a discount. And if you bought something between the 21st and the 30th, you've got to pay that within the first 10 days of February. So notice what happens this time. You're paying for two pieces in the month in which they were bought, and the other piece follows over here in February. So this wouldn't be 50-50. It would be like 2/3 and 1/3, or 67% and 33%. So the discount terms are driving how I'm paying for this. So when I come back to this over here, I hope now you can see that this is one 50% and this is a separate 50%, but they are not the same. So please, please do not think they are the same. But what I do know is this. I am always paying within the discount. This little 2%, if you were to annualize that for a full year, it's going to approximate somewhere around 38 to 40%, depending upon the days. That's a high amount of financing costs, so we're always going to take it. So regardless of whether it stemmed from last month and we're trying to pay that to get the discount, or if it's in the current month we're trying to pay to get the discount, those have to be factored in. Now, I'm not going to deal with a discount on the cash purchases. The discount is only allowed on that which is credit. Remember, we're trying to encourage someone to pay early. I don't have to encourage anyone to pay early if they're going to write me a check for cash right now. So I'll take the full amount. But when I get down here, I want to make sure that the discount is applied to everything that was on credit, which would be last month and the current month's credit. And of course, this is going to receive a 2% discount. And when I put that in, that's where the 1,480 results. And of course, I can subtract that away to say, well, that's the net amount you're going to pay. And I'll do this for February and for March, and of course the quarter over here as well. Now, just like we did back with the accounts receivable, let's go ahead and calculate what we still owe on accounts payable, which would show up as of the end of this. So basically that means that this accounts payable is going to represent the 80% of whatever we bought in March. And of course, we're going to pay the other half over in April. So the value of this would of course be the following. $44,181. I already knew it was going to give me that because in this case it's the 50-50 split. They have the same numerical value, but just remember they are two different pieces. Now, this is not always going to be true. It only is true in this case because of the discount terms being 215. Alright, now we're going to use this accounts payable again when we come and do our balance sheet. So let's look at the next budget, which is the labor. Now, the labor budget also has its basis in the production in units. So, again, I did not copy and paste. I did not retype. I referenced. So I went back to that production budget and said, I want that to be equal to what we said was in January. And, of course, I'll do that for February and March. The labor data is also on the data handout, and it's on the second page, and we know a couple things here. It says our direct labor is 1.5 hours to make a single unit, and I pay my employees $9 an hour. So you know the units we have, we know each unit takes 1.5 hours, so if you multiply those two together, you know the total time. And since you're paying $9 an hour, you can multiply the rate times the total time and you get your labor cost. I can do that for each month, and then of course I can just total across for the quarters over here. Now the labor budget is not as difficult as you can easily see. But please note that I am taking a simple approach here. I am assuming that everyone's getting paid $9, and that may not be true. You can have different classes of labor. Some people may work there longer, so their pay rate is higher. Some may be in a more skilled area, so the pay rate is higher. It just varies. And of course, as we all know, working jobs, there are other costs involved with your labor, such as the benefits, health insurance, retirements, Then, of course, there are payroll taxes that are involved, the Social Security, Medicare, unemployment taxes. The employers also have to pay these. Now, they are a bit beyond the scope of our class, but please note that any of those additional costs, whether they're benefits or taxes, would just have to be added on as additional line, and you would get an updated total. I'm just keeping it very simple and keeping it in basic raw amounts because we're doing so much already. I don't want to make it overwhelming. So our budget for labor is rather simple. All right, then my next one is the overhead budget. So we've got our direct materials, we've got our direct labor, we need our last production cost, which is overhead. So overhead consists of several different items here. And so a lot of these come from the data sheet. So let's go back and see where they come from. The first ones I want to get while I'm on the data sheet here is there are indirect labor costs there for maintenance. Maybe we had to get the maintenance guy to come in and do a repair on the machine, put some lubrication in it. And of course that's going to vary depending upon what we need. And so those values will show up as your indirect labor. And then up here on indirect materials, we have some for January, February, and March. And again, maybe this was some of the parts or the oil and grease that the mechanic used. Or it could be, an insignificant component in the product, like a drop of glue or what have you. But these are the indirect materials. So the indirect labor and the indirect materials, as you can see, I have just inputted them on the budget. Now, of course, that leaves me one other indirect labor item here, manager salaries. So, manager salaries, that data is on the first page. And it says right here that the following monthly expenses are expected. And there's your manager salaries right there, $7,000 a month. And as a salary, you would expect that to stay the same, but it can differ. You may have to hire another manager. You may have to give a raise. Maybe you're downsizing, so you get rid of a manager. So these can differ, so don't think that they'll always be the same. So we have the first three indirect items on here. And then we have utilities, rent, and depreciation yet to go. So let's look at utilities and see what it has. Now, I saw utilities over here. It was right beneath the manager salaries. And it says that it is 3% of your sales. So which kind of makes sense. The more you sell, the more electricity you're going to need to produce that product and so on. And so it's estimated at 3% of sales. But then there's something else down here about utilities. It says that utilities and rent are shared costs for both production and administrative. In other words, we have both functions in one facility, and of course we're not going to meter separate parts of the structure, so we're going to have to share it or allocate it. And so it says that utilities is really occupying about, let's just say, 80% of the space, so we need to take 80% and associate it with the product. So whatever we come up with here is our 3% of sales, we're going to attribute 80% of it to the product. And of course, that's what overhead is. It's a cost associated with the product. So let's just go ahead and put that 80% in there before we forget about it. And then I'm going to take 3% of whatever my sales are. And so that means I'm going to go all the way back to the very first budget, the sales budget, and say, I want 3% of January's sales right there, $270,000. So I want 80%, which is attributed to the product, and 3% of your sales. Notice again, I'm using cell addresses in my formula, so everything is linked. If we make a change, it'll roll through. And I'll also do this for February and March. And of course, all these quarters over here, I can just tally the rows. Alright, so let's think about rent now. Over here on rent, it said that rent Well, it's a flat or a fixed $5,000 a month. And you would think your rent would be fixed, but it can change as well. You had to renegotiate your lease, the cost went up. You needed more space, the cost went up. You needed less space, the cost went down. You moved, the rent changed. So don't think it's always going to be the same. It just so happens that it is in this case for simplicity. And again, I know that rent is 75% on product. So we're going to take 75% of this $5,000 and attribute it for any given month. So 75% times the $5,000, and that's where the $3,750, and I'll do this for February and March, and of course I can add it for the quarter. Now I did something rather unique on this overhead budget. I separated all of these deliberately because they all represent cash outlays. So I want to know exactly how much cash you spent for overhead. And this is just to save me a little bit of work on a future budget. And I'll explain a little bit more as we come to it. But I could have just done a whole big old list of overhead items, but by separating it out into the cash and the non-cash portions, it can save me some work down the road. And so we do have one non-cash cost over here, which is plant depreciation. And that says is $10,000 a month. And again, this could change depending upon if you acquire more or less physical structure to depreciate more or less equipment, what have you. So let's take 10,000, and you can see that's what I put here all the way across. And then I can do a grand total to get my total overheads for any month and the quarter. Now, I know I'm only dealing with 75% of the rent here and 80% of the utilities here. I know I've got to deal with the other amounts, and that will be on my next budget. But I'm going to pause here so that we can create a part 3 video.